Hello everybody and welcome back to the series where we cover the IGCSE Enterprise Syllabus step by step. If you haven't already, make sure to watch part 1 of Unit 6 because today we are going to cover the rest of Unit 6, Finance. Let's get right into it. First, we're going to discuss the pros and cons to the enterprise and the customers in the system of trade credit. If you don't know what the trade credit system is, we discussed it in the last video, so make sure to check that out. From the entrepreneur's perspective, when they are the ones offering the trade credit system, which means they will be the ones expecting the trade receivables, the advantages include boosting sales, improving competitiveness, and building stronger customer relationships. However, the risks are bad debts, cash flow problems, and the need for strict credit control. From the perspective of the customers that are expected to pay off their debt to the entrepreneurs, the advantages are flexibility in managing cash flow, easier budgeting, and the ability to buy now and pay later. But the disadvantages are debt buildup, damage to credit rating, and possible late fees. Now this slide is very similar to the last one, except the entrepreneur has become the customer, so the pros and cons are pretty similar, so I don't want to go over them to waste your time, but feel free to pause and read through the slide right now. Moving forward, let's go through some key financial terms. Number 1, cash flow forecast. A cash flow forecast predicts future inflows and outflows. Number 2, break-even. Break-even is when the revenue, which is the money that you make, equals the costs of running the business. So this is the state when you're not in a profit or loss. Number 3, income statement. An income statement shows income, expenses, and profit or loss. Cash inflow. Cash inflow is the cash that is moving into the enterprise, whereas cash outflows is the cash that is moving out of the enterprise. Number 6, surplus. A surplus means that the cash inflows are higher than the cash outflows, whereas a deficit means the opposite. So the cash going out of the business is higher than the cash coming into the business. Number 8, variable costs. Variable costs are expenses that vary directly with the level of production or sales, such as raw materials, because the more sales that you make, the more material you'll need. So the cost isn't fixed. Whereas fixed costs are the opposite. They don't change, so they aren't dependent on something else. For example, rent. No matter how much you make that month or how many sales you make, whether it's 1 or 100, the rent of the equipment or the capital you're using is going to stay the same. Now, total cost is the summation of your fixed costs and the variable costs. Number 11, contribution. Contribution is the money that's left from the sales after paying off the variable costs. The money that is left over is then used to pay fixed costs, and whatever remains becomes profit. But there are 2 types of profits. Number 12, gross profit. Gross profit is the profit a company makes after subtracting the costs of goods sold from the revenue. Net profit. Net profit is the final profit after all expenses, including operating costs, taxes, and interests are deducted. Number 14 are overheads. Overheads are ongoing costs that aren't linked to production. But I will say that this is a definition that you don't have to memorize. Now on this slide, I've listed the main formulas that you must know, so take a moment to note them down. Now let's discuss financial records in more detail. Financial records are essential because they show profit or loss, help manage cash flow, and provide legal and tax evidence. Income statements summarize financial performance and help assess profitability. Budgets plan income and expenses, helping to control spending and set goals. Cash flow forecasts predict shortages or surpluses, making sure the business can pay its obligations. This slide is very important because it covers all 3 financial documents that the syllabus requires you to know about. But how do you make an income statement, budget, or cash flow forecast? First, let's see how to create a budget. To create a budget, first list all your income sources. Then categorize your expenses into fixed and variable. Next, set limits for each category. And finally, track actual income and expenses against your plan. Number 2, how to create an income statement. An income statement starts with a total income. Then subtract expenses such as rent and salaries. What remains is profit or loss. Finally, adjust for taxes if needed. Number 3, how to create a cash flow forecast. To prepare a cash flow forecast, start by estimating inflows such as sales or loans. Then estimate outflows like rent or salaries. Add your opening balance, subtract outflows from inflows, and you'll find the closing balance. You have to review a cash flow forecast regularly to keep it accurate. Keep in mind, from my knowledge, I haven't seen a question paper that has asked you to prepare an income statement, budget, or cash flow forecast. However, the syllabus has required you to know how to make these and know the purpose and importance of each. And that's the end of part 2 of Unit 6. We've covered trade receivables, trade payables, financial terms, and how to prepare budgets, cash flow forecasts, and income statements. If you found this video helpful, don't forget to subscribe for more IGCSE Enterprise content. See you guys in the next video.